Good afternoon to you in Europe. Good evening to you in Asia and Australia if you are watching us. And good morning to you in the United States if you are just waking up and getting prepped for the trading day ahead. We've got a good one for you because it's that time again. It's time for the non-farm payrolls. We are live on YouTube and live in the trading room. As always, it's very, very nice to have you here with us today. It's going to be a busy session ahead. It's been a busy week and we're going to end the week on a strong note. No doubt. So let's get on with what we need to do. We are looking for 180,000 new jobs to have been created in the US over the past 4 weeks. That's down, markedly down from the previous September reading of 336,000. Are we going to get that? I don't know. I've been wrong on non-farm payrolls the last 2 months in a row. So I'm looking for a dovish print again, but that remains to be seen whether we're going to get that or not. So don't necessarily follow what I'm going to suggest. But I do think that we are well overdue for a downward tick in that unemployment data. So we will see how that comes in at. We're going to get some other measurements of jobs data as well out of the US this morning. We're going to get the unemployment rate as well. Now that is not expected to change. That is expected to be at 3.8%, and that could be the wild card once that data gets printed out. If it comes out at something other than what the market is expecting. Also, that average hourly earnings as well. Just keep an eye on that. It can be something that just pushes the volatility a little bit towards the end of the session, but it's a mixed bag today because the month-on-month rate is not going to be the same in expectations as the year-on-year rate. So, good morning to you. I hope you are doing well. We've got a challenge for you as well. If you fancy yourselves a free month's membership on the How to Trade website, come and join myself and Shane and Connor in the trading room every single day. We've got for 5 lucky winners today. If you are watching us live on YouTube, all you need to do is stick your prediction for what you think the non-farm payroll is going to be into the comment section on YouTube, and the 5 closest numbers, when that number gets printed, will win a free month's membership to the website. So please do get involved. It can't hurt. Just stick what you think in there. The market is looking for 180,000. So what is it that you're looking for? What do you think that we're going to get? Are we going to get 180,000? I'm going to stick my neck on the line. I'm going to go with 172. I'm looking for something that's under the print. So I'm looking for a very, very dovish. But just basically tell us what you think. If you think it's going to be higher, then stick a number in above there. If you think it's going to be lower, then stick a number in there as well. And whoever is closest to it, the 5 people that are closest to it, they will get a free month's membership. So please do join in and see what you can do. Okay, so what have we got to do for today? Hello to everybody that is joining us in the trading room as well. It's good to see everybody. Hamish, good morning to you. It's good to see you. And Jenny from the United States, hello to you as well. Hope everyone's had a good week. It has been a good week in markets. And hello to everybody on YouTube too as well. Okay, so we've not got too long to go, just over 10 minutes to go. And as usual, I've prepared far too much information. So let's jump straight in and get on with it, because otherwise I'm not going to be able to squeeze it all into 12 minutes. But I'll certainly do my best. So it is non-farm payrolls day. If you've never joined us before, then this is the biggest economic data print out of all of the Western economies. Every single month we get the US jobs data on the first Friday of every single month, and it's released by the Bureau of Labor Statistics. It's a government statistic, and we get 3 key bits of information: the non-farm employment change, we get the average hourly earnings, and then also the unemployment rate as well. And it's released at the bottom of the hour. That's normally 1:30 here in the UK. It's actually, the clock's changed here in the UK, so it's a bit of a mess. So thank goodness I got the timing right. Otherwise it would have all have happened by the time I'd have got here under normal circumstances. So that's happening at the bottom of the hour now, and that information is, I don't know, it moves markets, and the market does pay attention to it. Okay, so we do tend to get a lot of other jobs data as well, coupled in throughout the course of this week, and this week, this time around, it's no different. On Wednesday, we had the JOLTS job openings. That is basically how businesses view the jobs market. It stands for jobs, openings, and labor turnover, and basically is where the business sector is looking at the amount of people that have been hired, laid off, what sort of vacancies there are in the system at the moment, and retirements. And look at that number there, 9.553 million. It was a hawkish number. It was higher than expected, slightly higher than the previous number as well. So that's the robustness in the jobs market that has just been so prevalent throughout the course of the year, and I'm looking for that to end. Well, JOLTS is definitely not showing us that this time round as well. Also, we had The ADP employment change as well. This stands for Automatic Data Processing. It's a private company. It's a private bit of data, and they basically they track a fifth of US private sector workers, and they process their pay slips basically. So they have a lot of information of what is going on in the system. And this is, I think, is the more complicated one. It actually came out as slightly underwhelming because you can see there the market was looking for 150,000. That's a big step up from that 89,000 last time out in September, and we didn't get there, and we failed quite short of expectations. So even though we actually just pushed up a little bit, I actually think that's quite a dovish print, and the market, I think, has tied that in with the FOMC on Wednesday, and that is where we're seeing equity markets just step up a little bit over the course of the last couple of days. So it's a mixed bag in terms of what we can expect today. I mean, we can't actually use the jobs data throughout the course of the week as a proxy for what non-farm payroll is going to be. That never works, but this is basically the key important points that I think that we need to consider for today's non-farm payrolls, and that is, first of all, that JOLTS was robust, but ADP probably has been seen as slightly more dovish given the gap between the expectations and what we actually printed on the wire. Unemployment, that could be the wild card. Why? Because the market is not expecting unemployment to change there. You can see the market is looking for 3.8. So if we do get an uptick in unemployment, that will really sort of spark the volatility because the market has not priced that in. Well, I mean, the equities have priced in a little bit, but the market will always focus on the thing that it hasn't really considered too much. And then the average hourly earnings, that's expected to be a slightly dovish print as well. So we've got this sort of dovish tone is now starting to grow, and we've got a little bit of that from Jerome Powell as well. So I want to touch on that in a second if we get time. But let's just go to our game plan very, very quickly, because we always have to have some sort of a sense of what we are doing, and today is no different. Obviously, our game plan in the trading room is always the same. It's a stocks a down, dollar up play. If we get a hawkish number, that's a higher than expected number. It's a dovish print. It's a stocks up and dollar down play. I am veering on this downside here. I'm looking for stocks to now rally and the dollar to come down. I think it's a lot clearer and a lot cleaner on an equities and dollar index play rather than mixing in the currencies. Given what we had from the ECB a couple of weeks ago, and given the extra complication from the Bank of England this week as well, I think it's a much cleaner play. We're focusing on equities and we're focusing on the dollar index. So that's where I'm going to sort of like be looking for information from the market once the data gets printed out. So basically, so there's a little like hierarchy basically. If the non-farm payrolls is not particularly clear, if we get some sort of a number that's in the middle, or we can't really gauge too much of it, we move to the unemployment rate. And obviously, if we get a downtick in unemployment, that is dovish, and that is going to keep our stock market elevated, and it's going to put some pressure on the dollar. If we get an unemployment rate that's now ticking higher, then that's obviously going to be hawkish as well. Average hourly earnings, I'm not expecting that to be pretty much much of a game changer for the course of today. But who knows? You know, these things can they can change very, very quickly in markets. So let us just scoot over to what I think we've got just under 7 minutes now. So I've just got time just to touch on something very, very briefly, which I think is potentially going to be an important game changer over the course of the next few weeks and months, and that is what happened at the FOMC on Wednesday. Now, Jerome Powell has been talking the hawkish tone the entire time throughout this entire interest rate hiking cycle. That changed a little bit on Wednesday, and a lot of journalists after the event were saying, well, you know, we weren't expecting a hike from Jerome Powell. We didn't get it, and US rates have not changed. So therefore, at 5.5%, it was a bit of a mute. There's not really much going on. I completely disagree with that. I think there's some subtleties in the way that Jerome Powell was speaking that we have not seen, and it was basically this. There was one sentence that he said pretty much near the end of it as well that really sort of like caught some astute market participants by the ear and said, okay, well, we need to pay attention to this. He started the press conference pretty hawkish, pretty standard. Everyone's used to it. But then towards the end, it started to get a little bit more dovish. And this is the sentence that I pulled out as being particularly important. He said, we have come very far with this rate hiking cycle. And he emphasized very far. Now, that in itself, that's not a change of policy, obviously. But it's the fact that he emphasized it. it shows you where he's mentally positioning himself in the interest rate hiking cycle. And obviously, if you've done enough, the next thing you're going to do is then you're going to start to turn dovish. We have not seen anything like that from Jerome Powell since the very, very start of that Jackson Hole meeting for God knows how long ago it was. And then we went on this huge, great interest rate hiking cycle. And he has been just maintained that narrative the entire time, except for what happened on Wednesday. So I think that could be a potential game changer. Why is it going to be so important? Because I think he's got the luxury of being able to do that. I really think that he has got the luxury of being able to be slightly more dovish in his tone. Why? Because of the price of the bond markets at the moment. And this is the theory behind that. The bond market is now pretty low, and that is doing a lot of tightening for him. So if we do have any problems, he has the luxury of potentially creating some easing mechanisms to prop up any entities that are, on the verge of bankruptcy or anything like the SVB problem. And he's got a bond market that is now tightening the system for him. So if he does that, he can basically ease without pushing equities too high. So the whole notion that the problem before was that the equity market, if he was going to turn dovish, we're going to just race to all-time highs before the end of the year. I really don't think that is going to happen, and the bond market is helping him in that sense. That is a big shift. It's a big change. So I think that is going to be the important tone of the markets over the course of the next sort of like 2 or 3 months, and a very interesting take on how to interpret the subtleties of those press conferences. Okay, so let us move it on, and let's actually start looking at the markets themselves. Well, we can see I've been just watching the markets over the course of the morning as I've been putting the slides together for today's stream, and it really does look like it's the Dow that seems to be leading them at the moment. The S&P and the Nasdaq, you can see there on the left-hand side, they're pretty much bobbling around break-even about where we opened on the Globex range. So the markets have been relatively quiet, but it's that Dow that does seem to be slightly more optimistic, slightly more dovish than the others. So my focus is probably going to be on the S&P 500, which I will show you on the charts in a second. But I don't think that the Dow is particularly wrong. I am going to be looking for a dovish print, and we will see how we go. So let's just scoot over to the charts now, and I will show you how I've got all things set up for the course of the day. Now, you can just see here, I've got the S&P 500 in the top left. I've got the price of gold in the the top right. I've got the euro dollar, which I'm looking to push higher here. And although I don't like the euro dollar as a trade at the moment, but I prefer it on the Dixie, on the dollar index. You can see we've been just ragged in this whole big area of resistance. And so if we do get a dovish number, I think it makes the price action a lot cleaner, because it makes on the S&P, on the dollar index, it makes our job easy, because this is the next support point down here, coming in at around about 105.22. So I'm looking for equities to go higher. Support here would be down here at 42.64, and then here at 42.50. But the upper end of that, I think, is going to be way up here, back up here at this 4,400 area. Okay, so we've got just under 2 minutes now before we get there. Now, so equities, I'm looking for, this is the top of this range here on this 1 hour chart. You can see 4,400. I think that's going to be the upper end of where we'll get containment. Certainly, maybe not over the course of the day, but over the next week. That's if we get a dovish, dovish print on the data. Right, okay. So we got, okay, so we've got a minute now before we get there. Obviously, we're going to be looking for those 3 key bits of data. And just bear in mind as well that we can get a slight delay in the way that the market interprets the data. So if the unemployment rate is, if the non-farm payrolls is not particularly clear, then a lot of emphasis will move to the unemployment rate. So, okay, so I'll quiet it down. We've got just over 30 seconds now. And as soon as I get the number on the squawk, I will read it out to you.
20 seconds looking out for the US October NFP. Headline figure expected at 180K.
180,000 expected. Good luck, everyone. 5 seconds.
150k.
150. Wow. That's equities up. Equities up. Finally, the doves start to get their way.
Unemployment rate 3.9%. Private payroll 99k. The
Gosh, 150.
34.3. Labor force participation rate is 62.7%. So again, the headline figure 150k.
Wow. Brilliant.
Has also been revised down by 30%.
That's the dollar index now pushing down, as you would expect.
Was a tenth lower than
Take that lower now. Just bring that into focus. This is going to be the next area for me here on the dollar index. This area here from 105.19. That's not priced in. So 150,000. I've missed. Unfortunately, I've missed the unemployment.
lower than expected. Unemployment rate 5.7%, a tenth higher than expected. Participation rate is unchanged at 65.6%.
Gosh, really interesting. 3.9, slight uptick. Slight uptick. That is very, very interesting indeed. Finally, have we started to see some kind of a meaningful effect on the jobs market that we've not had, that we've been waiting for and waiting for and waiting for, and you hike the system, and then there's a delay in getting that all baked into the cake, and then finally we're starting to get there, and then we end the year where we have to then start then pricing in more dovishness into January, February, and March. Very, very interesting indeed. Gold up as a result, and then euro dollars. I was expecting that would then obviously push euro dollar up there. You can see this is the next port of call for euro dollar, a retest of this channel here that we've been following all throughout the course of the year. That comes in at 108.10. That is quite easily possible if we get some sort of more some dovish tone that really then starts to kick off in the price action. But it's really good to see that. Yeah, finally, I was wrong last month looking for the doves to have their way, and slowly now we're starting to see that pressure from the interest rates on the jobs market. Okay, well, that's lots to think about over the course of the weekend. As with all these types of data, quite often the initial market reaction, it can be slightly volatile. We've got more US data out over the course of the session today as well. So there's other stuff going on over the course of the afternoon. So just bear in mind that the jobs data itself can have a reaction, and then it can really then change on a sixpence over the course of the next few hours. But nevertheless, it does sort of like I don't know, it sets off a new tone, and I think it's a lot clearer if we get that kind of dovish tone now starting to embed itself in the system. It's overdue. That's the thing. And here's the thing: the data can lag and lag and lag and lag, but eventually you're just defying gravity. And there's been so many scratched heads over the course of the summer saying, where is this impact from all these interest rates? Well, hopefully we're starting to see it now. So really, really good stuff. Okay. Trader Mo's just said in the room. Trader Mo's just said. Let me see if I can bring it up. Trader Mo's just said many people do not want to work in America. I saw in Burleson, Texas. I saw a sign that said now hiring if you will show up to work, and it was a Kentucky Fried Chicken. Wow. Well, I mean, I know that Elon Musk was doing some stuff at the AI conference here. Yeah, and I saw a headline today saying that Elon Musk had said to the British Prime Minister Rishi Sunak that basically no one's going to need to work in the future. Yeah, well, how are people supposed to survive then? I mean, you're going to need to pay people something. They're going to need something to survive. But yeah, there's the attitude towards work is massively changed since COVID, basically. So I'm not surprised, So it's a very, very interesting environment and society that we now currently live in. Okay, that's everything we've got for today. So I hope you enjoyed the coverage today of the non-farm payrolls. Please do keep your risk in check. It's been a great week. If you've had a good week over the course of the last few days, please do not just mess things up as we go into the end of Friday, because the opportunities in the markets, they remain the same. The markets will be here next week. There's lots of stuff going on over the course of the next few weeks as well as we push into the end of quarter four. But there we go. The doves look like they've had their way finally after all this time. It's good to see. Enjoy your weekend, and we will catch you all very, very soon.